Welcome back to Cyber Trading University. Very happy you could join us here today. It's 10 a.m. Eastern. My name is Adam Rose. I'm very happy you could join us here today for day 2 of our discussion from yesterday, the options pyramid. Did everybody do their homework? Please take a moment to look at our risk disclaimer on the top of the screen. Always being aware that trading the stock market, options, forex market, any financial market for that matter, entails a certain amount of risk. We should always be acutely aware of that risk under all circumstances and under every single trading condition. But without further ado, let's get back to the topic. Now, what we spoke about yesterday is what we call the options pyramid, which are the 3 most important elements of trading the options market, the 3 elements that tend to affect the price of each options contract: price, time, and volatility. We talk about the movement in price. When the underlying stock goes up, calls tend to appreciate and puts tend to go down. And when the stock goes down, calls tend to go down in value and puts tend to go up. In other words, a call option tends to move in the same direction as a stock, the put option in the opposites. The other element, or the second element, in determining the strength of or the value of an option contract is time. That all options eventually expire, and as we get closer to expiration, the expiration date of each option contract, the value of that put or call tends to deteriorate. So we should always be aware of that and trade accordingly. Most specifically, that options tend to lose the greatest amount of value as we get closer to options expiration, which is typically in the 3rd Friday of every month. Weekly options, of course, expire very, very quickly because they expire every single week. And we should be aware of that time decay, and we can use that time decay to our advantage. Generally speaking, we don't like to buy very short-term options because the time decay tends to hurt us. We like to sell short-term options and buy long-term options. And the third element that affects the options price is volatility. The state of volatility will also affect the price of the underlying of the stock, the option. And that when the stock becomes more volatile, options tend to get more expensive because there's a greater probability of market action, so to speak. Stock that's more volatile has a greater probability to go up or down. Less volatile stocks have less expensive options, generally speaking. And generally speaking, what we look to do is buy options when we have a low period of volatility and sell options with a high amount of volatility. And then we can put all 3 elements together and we can determine what is the appropriate option strategy. Determining, first of all, if we're bullish or bearish. Do we think the stock is going to go up or go down? Number 2, what's the state of volatility? Is it low or high volatility? Low volatility, we like to buy options. High volatility, we like to sell options. And thirdly, time horizon. Do we have a short or long-term time horizon? If we think something is going to happen soon, we might want to exercise that trade in the short-term option. Or if we think the stock will move, but it's going to take a long time to do so, obviously we buy a longer-term option. So with that said, the homework is, let's talk about, and we're going to look at the Thinkorswim platform now. This is the Thinkorswim platform. There's a lot of different platforms we can use. I want to show you how you read this platform, and as well, how we can determine what may be the appropriate option strategy. So we're taking a look at Apple Computer right now. If you have any stocks that you'd like to talk about, I'd be more than happy to do so. But let me show you really quickly how to read this platform because it's really a lot of fun. Okay, so we have here a number of different settings. You can certainly customize them. This is the stock symbol. That's the underlying stock, Apple Computer. That's the last price. You have all the statistics for the stock over there. Then you have the option contracts themselves. Over here you have calls on the left-hand side. Over here you have puts on the right-hand side. In the center, you have the strike prices. Remember, every option is a strike price. If we buy a call, an Apple call with a 500 strike price, this is the 500 strike price to the left-hand, or the calls to the left-hand side. It gives us a right but not the obligation to own the stock at $500 a share. Now, on the call side, for example, and again, these are the calls on the left-hand side, we have the strike prices, we have the bid and offer. These are the actual prices for that actual option contract. To buy, we would buy the offer price. So, for example, 500, we'd buy it for $16. That's per share, or $1,600 for one option contract. One option contract is reflective, or gives us leverage to own 100 shares of stock. That's the offer to sell is at $15.50, $15.50 to $15.70. Generally speaking, I like to look for a bid offer, a spread that's very narrow. Here we don't necessarily have a very narrow spread. I don't like spreads usually more than 10, maybe 15 cents at the most. It's a little bit more here with the Apple options because it's such a volatile stock. On the left-hand side over here, we have the volume. That's the contracts, the number of contracts that are traded every single day. We have open interest. Anybody know the difference between volume and open interest? Volume is the amount of contracts traded every day, meaning today. It updates real time, just like the volume in the stock. You see 500,000 shares on the stock volume. That shows how many shares are traded today. Same as in options. The open interest represents the net exposure. I mean, remember, we have a finite amount of stock, shares of stock. If you have an issue, XYZ stock, that has 10 million shares outstanding, that will never change. We always have just 10 million shares. But in options, there are not a specific amount of option contracts that are issued every month because they expire every month. In fact, when we buy an option, it literally is a private contract. That's why it's called an option contract. It represents a private contract between the buyer and the seller. If the buyers and sellers choose not to place a trade, no option contracts are created. The open interest, which is over here, represents the total amount of exposure. That's open interest for the calls and the puts. On the left-hand side, these are the puts and these are the calls. The open interest represents the total exposure, the amount of private contracts that were opened at a specific strike price and by a specific expiration. Then we have what's called the Greeks. We have the delta, we have the gamma, we have the theta, and we have the vega, and there's actually more. These are the four big ones. There's actually the three very big ones are the delta, which is over there. That's the theta, and that's the vega. The delta represents how much we will make or lose in the option contract for every dollar that the underlying stock moves. For example, the 500 calls have a delta of 47. That means if Apple stock goes up $1, this particular option contract, which costs $15.60 right now to buy, if the stock goes up $1, we're not going to make $1 on the option, we'll make 47 cents. The theta represents the time decay, how much we're going to lose every day. That's why it has a negative number next to it. The theta shows us every single day how much that option contract will decline in value. Notice that theta for the puts and the calls is both negative. We lose value on both the puts and the calls every single day. So if we buy this option contract right now at $15.40 and we have a theta of negative 23, at the end of the day, if everything else remains equal, that new option contract will be worth $15.26 roughly, 27 cents. And then finally you have the vega. Vega is 63. Vega represents how much the option contract will go up or down based on a 1% change in implied volatility. So if the implied volatility, the state of volatility of the stock option goes up by 1%, we will make 1 unit of vega, which is 63 cents. So we buy this option contract for $15.60. Nothing else changes, and the implied volatility goes up by 1%. Our option contract will increase in value by 63 cents. These are the actual Greeks that we would really use, to determine what is the appropriate strategy. It does take quite a bit of practice to, get our understanding or get our hands around this, or get our understanding of how to use these correctly, especially when we talk about option spreads, combination of different option contracts used together. But if once we master these Greeks, I promise you, it's actually very, very simple. Once you master them, I'm telling you, it's a very, very effective and easy way to trade. I can promise you that. And then finally, we have what's called implied volatility. Implied volatility represents, it's a percentage, and it shows us how expensive or how inexpensive those option contracts are. When the implied volatility is very high, let's say 70% or 80%, maybe even 100%, that means those options are very expensive. Remember what we want to do, and this speaks directly, by the way, to volatility. It actually factors in everything together, but it mostly speaks to volatility, Vega. So when the implied volatilities are very high, it means those options are very expensive, and it's better for us when we have expensive options to try to sell them. When the implied volatilities are very low, such as 15% or 20%, it's better to look to buy them. Question is, why is the Apple contract goes around? It's actually it's the $5 increment, depending on what stock we're trading. It's determined by the price of the stock, but also the liquidity. You know, if we were to look at a stock like Ford, for example, you know, Apple's a $500 stock. Take a look at Ford. The strike prices occur every dollar. Those are the strike prices, 13, 14, 15, 16, 17, etc. Ford is very, very liquid and a low-price stock. Apple is also very liquid, but it's a very high-price stock. So really, it's not necessary to have those strike prices every dollar. As far as the actual price of the options themselves, 2040 by 2065, 1890 by 1790 by 1810. Well, I think that's just the nature of the markets. I mean, because again, remember, we don't have as much volume as we do in the stock markets. And, you know, especially when you're talking about a high price stock, you know, the market makers, you know, they determine the prices. And they don't say what the price is, but they determine the liquidity of it. They create the markets. They take the buy orders and the sell orders, and, you know, they obviously have to hedge themselves. If the market makers were to create stock options that would move every penny or would have a 1 penny increment, well, you know, it would represent probably either it would be too difficult for the market makers to take it to facilitate, or maybe it would represent too much risk. You know, there's a couple different reasons why. Usually the higher priced options, higher priced stocks, you tend to see options, you know, trade in slightly wider increments. But I'd like to turn it over to you. What underlying stocks do you follow? What stock, you know, call out a stock, give us an opinion as far as which way you think the stock is going to go. And I'd be more than happy to take a look at it together, because I think this is really, it can be a very helpful exercise. I see one for Visa, Costco, all good ones. All right. So let's first go to the charts. Before we do anything else, let's go to the charts. Let's go to the first one. Visa, I assume it's a V-I-Z-A is a symbol, or is it V? No, it's a V, right? I don't usually follow credit cards. It's V. Okay. So we have here the underlying stock price chart, and it's a daily chart. I'd like to start with a daily chart and a couple different things we're looking at. Let's zoom out here just a little bit more. Style, 3 days. Let's go to 9 months. Daily chart, 9 months. All right. So we take a look at the stock charts. What's our opinion, first of all, as far as Visa is concerned? Do we think it's going to go up or down? If you ask me, I think it goes down. I think it goes down a lot. This is just based on the chart alone. You know, we have a very nice support level over there. This was an earnings report right at this level. By the way, that little blue light over there, that's an earnings release. And we have obviously the dividend. That's a dividend announcement, but that doesn't really affect us as much. But it's important to note when the earnings are, because this marks a line in the sand. This tells us, okay, the stock went up, 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 up. Some people probably said the earnings were going to be good. Other traders said the earnings were going to be bad. But this is actually, now we have the news. I have no idea what the earnings were for Visa, but I'm guessing they probably, you know, whatever it may be, it's probably not good. Not based on necessarily the initial market reaction, but after the fact, we've seen a big move lower. And we've broken below, it looks like this very big support level around 180. That was a large round figure. Maybe we'll find support. What's our price targets? Well, the next big increment we have here, the former resistance could be new support, maybe at 170. But I think I'm pretty bearish. I'm more bearish. I agree with you. I think the Visa is going to go down. The dollar sign is ex-dividend date, not payment. I believe you're correct. I think that's when the dividend was declared, or maybe ex-dividend. I really don't know. Federal lawsuit. Oh, that was a law. Well, that's certainly not good. You know, that's even sometimes that's more important than the earnings. Any kind of big fundamental event. And look, that big fundamental event occurred with a lot of volume, and we're below those lows now. I'm bearish on Visa. I say conservatively go to 170. There's another big level at 160. Now, so first thing we have to determine is the direction. The direction, we'll put a down arrow. How about volatility? What do we think in terms of volatility? Take a look at two indicators we can use to measure volatility. Number one, we have the Bollinger Bands over here, and we notice that they've started to widen out. Volatility has started to expand. That's high volatility. It is expanding. It is increasing. I agree 100%. It may expand further, but it's definitely on the higher range. Also below, I like to use what's called the ATR, which stands for the average true range. By the way, I always use the standard settings. You know, sometimes traders will ask, what settings do you use for all these indicators? I always use the standard settings. I like to see what everybody else sees as far as indications are concerned. Now, the ATR measures the length of the candlesticks. It actually takes into consideration the open, the close, the high, and the low. It shows us the average length of the candlestick. And we can see, and this chart's going back about 9 months or so. So historically speaking, we can see that the volatility is really expanding. Now, volatility is expanding in the Bollinger Bands and is confirmed with the ATR. Will it continue to expand forever? No, eventually it'll turn to the downside. I think the ATR already starting to decline. But we know in terms of regression to the mean, we're definitely volatility is at the upper end. So what's my opinion? Right now, volatility is high, and that I think it will decrease over time. So I'm going to put a down arrow. I think volatility is going to go down. Okay? That means we want to sell. We're bearish on the stock. In terms of volatility, we want to sell volatility, meaning I anticipate that I think the volatility eventually is going to go down. I don't want to buy volatility because it's already gone up too much. We want to trade volatility the same way we trade stocks. Buy low, sell high. Buy low volatility, sell high volatility. I think relatively speaking, we're closer to high volatility. Now, does it mean the volatility can't go up more? Yeah, of course it can. But that goes into the timing. We already know what does a chart tell us right now? Volatility is high. And then time. How much time do we think it's going to take for Visa to go down further? We're bearish. I want to sell. I don't want to try to buy tops and bottoms. A trend is your friend. I always like to say, trade the chart that's in front of us. You know, it's tempting to say, well, Visa's down and maybe we can pick a bottom. But, you know, it could stop at 170. It could stop at 160. It could stop at 150, or maybe not. You know, a really good friend of mine, a great trader, you know, used to say, I used to day trade them for years, and he used to, you know, say all the time, never buy a stock with bad news. You can buy a good, you can never try to buy a stock with bad news. You can sell a stock sometimes as good news because, well, good news, it's motivated, stock goes up, it's motivated by greed. And if we think the stock is going to go up, how much of our total net worth, how much of our total, if we have $100,000 in our trading account, or it doesn't matter the level, $1,000 in a trading account, if a stock has good news, how much are you going to put in? Well, maybe 25%. Maybe 50% if you love it, maybe 75% of your trading account. You don't over leverage yourself, right? But if you own 100 shares of a stock and it comes out with bad news, how much of that stock are you going to sell? All of it. That's why markets go down a lot faster than they go up. We don't necessarily commit 100% of our equity when we buy a stock with good news. Greed is a powerful emotion, but fear is more powerful. And also, the problem is bad news. Bad news has a way of leading to more bad news. Remember, once upon a time, there was an energy stock that was at $40 a share, and they came out with this little article, this little news report about a little investigation about some kind of reporting accounting errors, accounting issues in this energy company. It was known as Enron. And the stock went from 40 to 35 and then to 30. And people said, oh, well, 30, it's oversold now. I think it's going to go back up. I have a buy target on it, you know? Eventually, we all know what happened. It went to zero. So never try to buy a stock with bad news. I'd rather trade the trend. Now, and it appears the trend is to the downside. As far as time, how much time do we think do we need? I'll ask all of you. A short amount of time. Think of where we are on the calendar, by the way. It's August 15th. Within the next 2 weeks in August, we don't really have any kind of earnings. We don't have any Federal Reserve meetings. We have a couple economic points, but a couple economic reports. But you know, generally speaking, the last 2 weeks in August are not that exciting. Would I use Fibonacci arcs? You can. I don't. I know you told the Fibonacci arcs are these sort of curvy Fibonacci projection and extension and retracement levels. You know, I have used them in the past. I'm sure it would definitely add some value. I personally don't. I think, you know, what we have in the chart right here is really more than enough. But I certainly would encourage you. I mean, if you find a way to use it, yeah. And Fibonacci, by the way, is certainly a very, very good tool to use. But for those of you who've been following Visa, if you're negative on Visa like I am, what do you think? How much time do you think it's going to take for the stock to accomplish a big move? I would say it's probably going to go down the next couple of weeks. But what's the probability that's going to make a big move? I would say it's probably going to take some time. And to be honest with you, I would say it might take, I really think that if we see a big move down, it probably is going to occur during the next earnings season, which is also considered a very negative time of the year to own stocks, October. October earnings are very dangerous. It's a very dangerous time of the year to own stocks. And if you have a stock with any kind of bad news, a lawsuit, weak economic conditions, whatever it may be, October is a magical point for that stock, and you know, maybe not necessarily a good time. So the time horizon, I want to say, you know, actually like almost like a medium to long term. Not long term, you know, a year or so, but I would say, where are we, August or September, October, you know, maybe even November. Let's just use October. In fact, a better way, yes, this is what we can do. We'll see when they report earnings. I want to know that, right? Earningswhisper.com. Symbol is V. Earnings date is October 23rd. When is options expiration? Options expiration In October is the third Friday of the month, which is the 18th. We want to be aware of that. It's the third week. It's the third Friday of the month, which is October 18th. This visa does not report until the 23rd, which means I want to give myself the opportunity to take advantage of this and maybe hold a position into earnings. So let's go to the option calendar, the option screen now, right? So we're going to type in V. Let's go down. We have our September options, and we don't necessarily have all the options. But let's go down to the Decembers. We have Septembers. We don't have October, November. We do have Decembers. Again, this is at the discretion of the market maker, how they choose to, what options they choose to issue. Well, Visa right now is $174 a share. And I am of the opinion that I think Visa is going to go down. It'll be below $175 a share between now and, well, the next contract we can look for is December. So what do I want to do? Remember, in terms of direction, I'm bearish. Volatility, I'm bearish. Time horizon, long-term, December. I'll ask all of you, what is the appropriate option strategy? A call or a put, buy or sell? We already know what the time is. 100% correct. Sell a put. Does everybody see why? Well, if we're bearish in the stock, if we're negative on the stock, we can either buy a put. No, I'm sorry. It would be to sell a call, not sell a put. Remember, if we're bearish on the stock, I'll draw a little chart here. This is the easiest way to think about it. Okay? Here's a bullish. Bullish means optimistic. We think it's going to go up. Bearish, we think it's going to go down. Right? We have our calls and we have our puts. I like to draw these little charts. I find it very helpful. So, if we're bullish on the stock, if we think it's going to go up, what can we do? We could buy a call, B for buy. Or we could do something with a put, but it has to be the opposite. Sell a call. Sorry, what am I doing? No, sell a put. Buy a call or sell a put. If we're bearish in the stock like we are in Visa, what can we do? Buy a put or sell a call. Does everybody see how that works? You always just invert it. From bullish to bearish and from calls to puts. Remember, calls move in the same direction as the stock. So if I think the stock is going to go up, I want to buy the call. Make a little asterisk next to that because that's in the same direction as the stock. Calls move in the same direction as the stock. So I could buy a call or sell a put, but we're bearish, so what do we want to do? We could either buy a put or sell a call. What will determine what we should do? Volatility. If volatility is high, then we want to sell. Sell or sell. See how we narrow it down? Question is, again, why not buy a put? Because the puts are already very expensive, according to the volatility. Okay? Eric, Ed, do you see why that is? We don't want to buy a put because according to the charts here, the volatility is already very high. You don't want to buy options with high volatility as the stock's already very volatile because that means those options will be too expensive. We get on a plane and we go to Las Vegas, we go into the casino and say, I want to place a bet on the #1 baseball team in the country. We're going to get the best, we're going to win. We're going to win everything. Well, the casinos is fine. If you want to win $100, you have to bet 300. Say, wait, why are you giving me such bad odds? The casino says, well, we're giving you bad odds because you're betting on the first place team. It's already factored in. You say, well, no. How much How much is the bet for the last place team? You said, oh, the last place team's different. If you bet $1, you could win $100. Say, well, that's a lot better. They say, sure, it's probably not going to win. The options market changes according to the probability of success. And when volatility is high, what's the probability? The volatility is very high. The stock could have a big move. There's a high probability. Now, here's the difference. And Eric, I see your question. I promise I'm going to get to it. But take a look at this. We're looking into December options. Look at the implied volatilities. They're actually, relatively speaking, they're still actually kind of low. This is not something, this is implied volatility. These are the calls. These are calls and these are puts. Implied volatility measures the actual price of the options. The options themselves are actually still relatively cheap. What's the magic level? 40%. If implied volatility is greater than 40%, it means those options are expensive. If it's less than 40%, they're actually cheap. The implied volatilities here are actually kind of cheap. They're inexpensive. So, you know, when we talk about volatility and we look at, you know, the Bollinger Bands, it's a way for us to approximate what's going to happen. Let's go back. Maybe that's too much time. That's 10 years. No, it's still, the volatility, you see the difference is this. When we look at the stock price, I know I'm kind of getting a little bit more advanced here, but I just wanted to mention this as well. When we talk about volatility, there's two kinds of volatility. You have a stock price and you have historical volatility. That's the Bollinger Bands, that's the ATR, and that is high. When you talk about the options, we measure a different type of volatility. It's called implied volatility. We look at this, the price of the options, the bid and the offer. We see how expensive it is to buy or sell, to buy a call or put. And that determines that the implied volatility looks at the calls and the puts and says, oh, those are very expensive. Those are a little less expensive. So we look for situations where, say, the historical volatility is greater than the implied volatility, and it shows us the options actually undervalued. So the Bollinger Bands, the ATR, is a great way to approximate states of volatility, but if you really want to do it the right way, you're going to have to use the Greeks. I'll show you both situations, though, if this was low and high volatility. Question, December seems to be a strong month for Visa as holiday credit offering. Absolutely, it's a great question. You know, especially when we talk about options, Eric, it's a great question. We should really pay attention to the seasonal attributes, the seasonal things that tend to occur. Earnings season, it tends to make stocks very, or options very volatile and expensive. For those retail stocks like Visa and, you know, the retail, the stores themselves, they certainly, you know, most of their sales occurs during the holiday shopping at the end of the year. Oil tends to get more expensive in the summer times. Hershey sells a lot of chocolate during Valentine's Day. Budweiser sells a lot of beer in the summer. You know, there's those seasonal things. You know, the market's us. It's buyers and sellers, and we're all, you know, we're all human. We're all, you know, watching the same things and thinking the same things. You know, in the old days, I don't know if it still holds true, but in the old days, there used to be a rule of thumb that says if you were to buy Disney stock every year in the third quarter, you know, meaning right before the holidays start, before Thanksgiving, and sell it in March in the first quarter, you would outperform the Dow Jones Industrial Average by, I don't know, X percentage points. Why? Because it's in the wintertime, and a lot of people in the Northeast, you know, New York and Pennsylvania and Boston, what do they do in the winter when it's freezing and you have winter vacation? Go to Disney World, We're Disneyland. So, you know, certainly the seasonal effects like holiday shopping, it could have a big effect. And you'll watch the implied volatility, the value, the barometer of those options coming into the holiday shopping, and you'll get a really good gauge of it. If you sell a put, how can you cover so you're not negative position, which is exactly what I'm going to talk about now. What is in the left column? Are you referring to all the way, Richard, all the way to the far left? We start over here, volume, open interest, implied volatility, delta, gamma, theta, vega, theoretical price, bid, offer, bid and ask. I know it's kind of hard to see over there, but those are the little titles, I should say. Is this all you're referring to all the way on the left-hand side? That's the time in sales. That's the time in sales for the actual stock. I like to watch that too. I like to look at prints and things like that. Okay, anyway, so let's take two situations with Visa. We have, let's see over here. We have so we decided we want to sell the December puts. Let's look, first of all, let's look at the 175 puts. We'll pick a level that we think the stock is not going to go above. It's 175. These are the puts on the left-hand side. So all I'm going to do is watch below. I'm just going to click on the bid price, meaning we're going to sell to the bid price. Click on 175. You can see what pops up below, right over there? This is in the demo account, of course, which is always a good place to practice. A single trade to sell, that's a -1, shows our position. V is Visa, the underlying stock. December 2013 is expiration. 175 is a strike price. Puts. Whoops, we're not selling puts, we're selling calls. What am I doing? We're bearish in the stock. So, we want to sell the 175 calls. We think the stock is going to go down. Okay? So once again, thank you. I almost forgot. Single sell. Short position that confirms it. Visa, December 2013, 175 call option. We're going to collect $10.15. That is going to go into our account. 26% implied volatility. Okay? Now, click on the risk profile button on the top left-hand side over here and look to see what happens. Remember, the strike price was 175, which is right over there. This is our maximum profit potential. From 175 on down, it means that if the stock closes at or anywhere below 175, we keep the entire $10.15 times 100 shares is $1,000. It's like we're at the casino and we're the dealer, and somebody walks up to our table and says, I want to make a bet that I want to bet on red. And they give us money and they put the chips down and the ball ends on black. What happens? We just keep the money and the guy walks away. Why is that? Because the bet, they lost the bet. Someone else out there is trying to buy a call. They think Visa will be above 175 by December. We think it'll be below. We're betting them that it's going to be below. As long as it's at 175, 174.50, or all the way to 0, doesn't matter. The bet was above or below 175. It's a call, which means it's bullish. We're selling a bullish option, which means we're bearish. Now, notice what happens. To answer your question, to Kevin's question, notice the P&L as the stock goes up. 177, 178, 80, 200. If the stock goes to 200, we could lose $1,000. In fact, we have unlimited losses. What happens if the stock goes, I mean, who knows, maybe they'll have a great quarter. What happens if it goes to $270? We could lose $8,400 on this trade. It's like shorting a stock before it explodes. It's a very risky thing to do, and I would say never, never, never sell a naked option. Oops, let me contract this here. What's a naked option? A naked option is if we sell a call or put, it doesn't matter, with no protection, no insurance. It's like shorting a stock without a stop order. Very dangerous, right? Well, how do we counter that? Well, we would put on insurance. This is a simple credit, a debit spread or vertical spread. Vertical spread is the best way to think about it. Why is it vertical? Because we're looking at the 175 calls. We sold the 175 calls, so we're going to buy another call. We want to spend less money higher up, and that will be insurance. So if the stock goes up above 175, whatever we lose on the 175, we'll make back on the second one. It's called a vertical spread because we look vertically on the strike prices. So we bought the 175, we sold the 175, and we'll buy, let's say we'll go up $10, we'll buy the 185. Okay, so we sold the 175, we bought the 185, we're going to click on the offer and look below. This is how the math turns out. Remember, the first trade, sell, Visa, 175 call, we collected $10 in premium. For insurance, remember, we always spend less in insurance than we do on the car. So we're going to buy, there's a +1 Visa, same expiration, strike price, higher up. How much are we going to spend? $6.10. We took in 10, we're putting out 6. Net, what's the difference? 400. Go back to the risk profile, and this is how it works out. Lower strike price, 175 is our maximum profit potential. We have the potential to make as much as $390. By the way, it's a little window over here. This shows us our profit potential. 300, we said 400, it's actually 390. Where does that occur? At 175 or below. How do we know that? Because that's the short option. Where's our maximum loss? At 185 or above. How do we know that? That's our long option. Anything above 185, we lose the maximum of $605. Risking 600 to try to make 400, it's not a 1-to-1 risk-reward ratio. It's pretty close, though. This little line over here, by the way, just below 180 is our break-even. Break-even. That's 0. Okay? This is maximum profit at 175 or below. This is maximum loss at 185 or above. So if we were to sell this option, we would want to buy protection, insurance, and this is how we would do so. Let's take a look now. Let's take the other side of the coin. Let's erase all this. I know we spent so much time in this. I really want to try to get to as much as possible, but I want to make sure that we show some real life examples of ways we can use this information. So Kevin, I hope that answers the question. You always want to buy insurance. If you're selling a call, buy another call. If you're selling a put, buy another put. Never sell an option naked, meaning alone. If you sell an option, you have to buy something else to protect yourself. Now, let's say we think the stock is going to go down, Visa. We think it's going to go below 175, but the volatility is low. In that case, we don't want to sell the options. We're going to buy the options. So what's the same thing as selling a call? Well, not the same thing, but the same direction. We could buy a put. So let's look to buy the 175 put. And again, this gives us the right, but not necessarily the obligation to sell short the stock at $175 a share. So what are we going to do? We're going to click on the offer right over there. We're going to buy below. We're going to buy here. Buy. +1 means we're long the put. Visa, the underlying stock, December 2013, 175 strike price. Put option. This is going to cost us $11.25 per share. Every contract represents 100 shares, so it'll cost us about $1,125. Say, well, that's a lot. That's an expensive option. But let's take a look at it. This gives us a right to sell short the stock at 175 between now and December. Click on the risk profile. Take a look at this. 175. And how do we factor in our break even? Well, it's 175, but we have to spend $11. So that we need the stock to go down at least $11 in order to pay for our options. What's 175 minus 11? 164. Right over here. That's our break even. Now, when you buy options, you don't need the protection. Remember, we're just buying an option. You don't need to worry about insurance. This is a break even right over there. Anywhere below 164, we start to make money. And of course, the faster it moves, the more time we have on our side, the better we're going to do. But take a look at this. If the stock goes to 160, I'm looking at the bottom left-hand corner over here. If the stock goes to 160 by December, we'll make $380. 150, we can make $1,300. 140, we can make $2,400. What if the stock goes to $100 a share? What if Visa? What if there's a lawsuit? I have no idea what the news is. But what if it's really, really bad? What if the holiday shopping season is horrible? What if the October earnings season is horrible? $175 stock exposed to retail and banking, that could be some really bad news. If the stock, just to give you an example of the potential, if the stock between now and December goes to $100 a share, your $1,100 option that will cost you $1,100 right now will be worth about $6,400. Almost 6 times, 600% return. In fact, as the stock goes down, you have virtually unlimited profits. Of course, the stock can't go below zero, but nevertheless, the stock could go down. It's virtually, if you buy a call, you have theoretical unlimited profits. But think about it this way. Let's say the stock goes to 150, and that's pretty reasonable. The stock goes to 150, that means we could make about $13.65. Let's do the math here really quickly, okay? We're saying that the stock by December goes to $150 a share, okay? If the stock goes down to 150, it's 175 to 150, which is a $25 decline. What's that percentage-wise? 25 divided by 175 equals 14% return on investments, ROI. That means in your trading accounts, if you sold short 100 shares of Visa and it goes down to $150 a share, you make a 14% return on investments. And by the way, that means you need to sell short $175 stock, which means what? You need $17,500 in margin just to take the position, plus you need extra margin. I mean, this is, for all intents and purposes, over a $20,000 trade. Let's look at the option, the put option. The stock goes from 175 to 150. 150, what do we say? It was on 1365, right? So the option right now is $11.10. And it would go, I don't want to erase all this stuff. Okay, it would go to 1365. How much is that, percentage-wise? 1365, I think it's 1365, minus 1110 equals 255 divided by 1365 equals a 19. That math can't be right. It's got to be better than that. I'm sorry. I got to erase all this. And look, if the stock goes to 150, It is better than that. It's 13. It's about $1,400. $1,400, and the stock right now 1,400 minus 11. 1,400 minus 1110 equals 290 divided by 1110. 26% return on investments. Okay. That's the option, 26% ROI. The stock, 175, 25 divided by 175, 14%. And that's return on investment, ROI. What's the capital requirement? How much do you have to put down? Well, that's $17,500 to sell short, and it's more than that because you need that margin just to take the position, plus then some. What will this cost you? $1,100. So you're putting in much less money to make more money. That's one of the huge benefits of trading the options market. So let's see how that works. And this isn't even really a great example. The more it goes down, the more your option will be worth exponentially. Lastly, and I know I'm sorry, I apologize we didn't get to some of the other stocks. I did not mean to get so caught up on this one situation. But just to give you a better idea of the power of knowing how to read the options platform, you take a look at the puts, for example. Okay, we have the bid and we have the ask. We have the delta. What's the delta if we buy those puts? What's the delta? It's -40. It's negative because it's a put, which means it moves opposite the stock. What does the delta mean again? The delta represents the relationship between how much a stock moves and how much the option moves. The stock moves $1, the delta will move 1 unit of delta, which in this case is 48 cents. So if the stock goes from 175 to 150, that's $25 times a delta of 0.48 equals $12. Okay? And this is actually how you do the math. $12 divided by an $1,100 stock. 1,100. That's about 109% return on investments. But that's just a delta. Remember, we also have the theta. That's the time decay. Every day, you're going to lose right now negative 0.04 cents. But as time goes on, the theta will increase in value. And then, of course, you have volatility, vega. If volatility increases, these options will become more expensive. If I buy the puts and then Visa, which is right now pretty volatile, all of a sudden explodes to the downside. The volatility just completely explodes. You're going to make a lot more. Point being is that to put this trade on correctly, we have to take into consideration delta, theta, and vega. And it might not involve one option contract alone. It might involve using a combination of calls and puts, buying and selling different options. But the beauty is when you get this right, when you put all the ingredients together, it's unbelievable. And we can discuss option strategies where we make money if the stock does not move. I can name a couple stocks I think won't move. So, certainly, to be on the right side of the options market, to have a very good grasp of how this works in terms of the Greeks, it can make all the difference in the world. I apologize again, we didn't get to the other stocks, but, I really wanted to make sure that we really discussed at least one example with, a tremendous amount of detail, which I think I think we've explored Visa as much as we can. By the way, I only mention this because it's coming up soon. If you're interested in learning more about this, if you're interested in taking the next step, next week, August 19th and 20th, and by the way, this workshop, the last time we taught this workshop, it was a 2-hour workshop. It's now an 8-hour workshop. It's Monday, August 19th, 10 to 12 and 4 to 6. Tuesday, August 20th, 10 to 12 and 4 to 6. Okay? All the sessions in the workshop will be recorded. And in the workshop, we're going to talk about the Greek specifically in a lot of detail, the delta, the theta, the vega. And then what we're going to do is we're going to talk about how to use them in strategies. A calendar spread involves 2 contracts, same strike price, different expiration. Verticals is what we talked about before. Same expiration, different strike price. Time diagonal is a combination of both. Different strike price and different expiration. Ratio spreads, butterflies, and my absolute favorite, the iron condors. That's where, you have a strategy where you think the stock is going to stay in a range and you're selling calls and you're selling puts. And as long as the stock continues like this, you're going to make money on everything. Oh, thank you, Stephanie. Stephanie, I completely forgot. Stephanie is our resident option educational advisor over here. Her extension is 115. Call our offices if you have any more questions about this workshop. It's normally $189, but for those of you that are in a cyber group, knock off $50. It's only $139. Look, even at $189, there's a lot. It's an 8-hour workshop. I mean, this is something I think that a lot of other, if you were to find this material, it would be a full course, and you get, obviously you get to keep the PowerPoints and all the education material, all that stuff as well. It's next week. Again, it's only $189. It's a very, very small investment. Obviously, you can see the power of if you know the options market, if you know how to use the Greeks, it could be tremendous. Anyway, I thank you all very, very much for joining us. Excellent questions. I look forward to seeing all of you next week in our option workshop. I think it's going to be a lot of fun. And I'm getting a private chat here. I wasn't. Look, okay. I just got in a private chat. I got this chat from our management. Look, the price is $189, and it's $139 discount to the cyber group members. I was just told that even if you're not a cyber group member, it'll still be $139. We found that this is a very, very helpful workshop, and so the price. It doesn't matter if you're a cyber group member or not, but you have to call in. That's the thing. It's $139, but you have to call us. Okay, but we're very nice on the phone, so don't worry. Call, ask for Stephanie. She's at extension 115. If you speak with her, you'll get the discount for $139. Okay, it doesn't matter if you're a cyber group member or not. Okay, thank you very, very much for everybody, again, for joining us. I wish you all the best of luck. I look forward to seeing you all back very soon. Have a great day, everyone.